I want to begin this video with something that almost never happens in the world of high finance. I want to begin with honesty. Real, uncomfortable, no sugarcoating honesty about where we are right now and what the smartest money in the world is actually doing versus what ordinary Americans are being told to do. Because there is a gap between those two things right now that is wider than it has been in a very long time. And that gap, if you do not understand it and act on it, could cost you a significant portion of everything you have saved over your lifetime. The man at the center of this conversation today is Stanley Druckenmiller. And the question I am going to answer in this video, as specifically and as practically as I possibly can, is this. If a market crash started tomorrow morning, what would the exact portfolio look like that Stanley Druckenmiller's philosophy, his framework, his decades of thinking about markets and money and risk would point toward? Not in theory, not in vague generalities, but in actual, concrete, specific terms that a person between 60 and 75 years old, a person who has worked hard and saved carefully and who cannot afford to get this wrong, can actually understand and actually use. Now I want to be precise about something before we go further, because precision matters here. I am not claiming to have access to Druckenmiller's private brokerage statements. What I am doing in this video is something that I think is actually more useful for you. I am taking everything Druckenmiller has said publicly in interviews, in speeches, in rare media appearances over the last several years, and I am building from that a coherent, philosophically consistent portfolio that reflects his actual thinking, his actual framework, his actual view of risk and value in this specific economic moment. Because Druckenmiller is not someone who speaks carelessly. When he says something publicly, it reflects deep conviction built on rigorous analysis. And the picture that emerges from his public statements, taken together and understood in context, is remarkably clear and remarkably actionable if you know how to translate it from the language of a billionaire fund manager into the language of a retired or near retired American protecting 30 or 40 years of savings. Let us start with the foundation of Druckenmiller's entire investment philosophy, because you cannot understand the portfolio without understanding the thinking behind it. Druckenmiller is, at his core, a macro investor. That means he does not start by looking at individual companies and asking which ones are cheap or which ones have the best products. He starts by looking at the biggest forces in the global economy, things like government policy, monetary conditions, the direction of interest rates, the flow of capital between countries, the long-term trajectory of currencies, and he asks where those forces are pushing the prices of broad asset classes. Then he positions his portfolio to benefit from those macro forces while protecting against the risks they create. This top-down approach is fundamentally different from how most ordinary investors and most financial advisors think about building a portfolio, and it is one of the key reasons his results over 50 years have been so dramatically different from average. He is not trying to pick the best stock. He is trying to understand the world and position himself correctly within it. So what does Druckenmiller see when he looks at the macro landscape right now? What are the big forces he is reading, and what do they tell him about where to position a portfolio if a crash is starting tomorrow? Let me walk you through his thinking systematically. The first and most dominant macro force in Druckenmiller's current worldview is the United States government's fiscal situation and what it means for the value of the dollar and the level of interest rates over the next decade. America is running annual budget deficits of roughly $1.5 to $2 trillion. The The national debt is above $34 trillion. The interest payments on that debt are now approaching $1 trillion per year, which means somewhere close to 15 to 20 cents of every federal tax dollar collected goes purely to paying interest on past borrowing, not to building roads or funding schools or paying for the military, just servicing debt that already exists. Druckenmiller has said explicitly that this trajectory is unsustainable, that at some point the bond market, meaning the investors around the world who lend money to the United States government by buying treasury bonds, is going to demand higher compensation for the risk of lending to a government that is borrowing at this pace. And when that happens, interest rates could rise significantly, the dollar could weaken, and the prices of long-duration assets, meaning assets whose value depends on projecting cash flows far into the future, could fall dramatically. The second major macro force Druckenmiller is focused on is what he sees as a structural shift in inflation. For 4 decades, from roughly 1980 to 2020, inflation in America was on a long, gradual downtrend. That downtrend was driven by globalization, which kept the prices of manufactured goods low, by technological innovation, which drove down the cost of information and communication, and by the entry of hundreds of millions of low-wage workers from China and Eastern Europe into the global economy, which suppressed wage growth in developed countries. All of those forces are now reversing or significantly weakening. Globalization is going into partial reverse as countries prioritize supply chain security over pure cost efficiency. The demographic dividend of cheap labor from China is fading as China's workforce ages and wages there rise. And governments around the world, having discovered during COVID that they can write enormous checks with seemingly limited immediate consequences, are much more politically comfortable with deficit spending and monetary accommodation than they were before. Druckenmiller believes this means inflation is likely to be structurally higher over the next decade than it was over the previous 4 decades. Not necessarily in a straight line upward, but higher on average, more persistent, more difficult to fully suppress without causing significant economic pain. The third macro force shaping Druckenmiller's thinking is what he sees as a potential inflection point in the artificial intelligence revolution and what it means for equity valuations. Druckenmiller has been genuinely excited about the long-term transformative potential of artificial intelligence. He has made investments in AI-related companies, and he believes the technology is genuinely revolutionary in ways that will reshape economies and industries over the coming decades. But he is also deeply concerned about the gap between the genuine long-term promise of AI and the current valuations being assigned to AI-related stocks by a market that is, in his view, extrapolating too aggressively too quickly. The largest technology companies in America are trading at valuations that are historically extreme by almost any measure. And when you combine historically extreme valuations with rising interest rates, which make future earnings worth less in today's dollars, and with an economy that is showing signs of stress beneath the surface of the headline numbers, you have the conditions for a significant repricing of the most expensive parts of the market. Now, holding all 3 of those macro forces in mind simultaneously, elevated and rising government debt with potential dollar weakness, structurally higher inflation, and overvalued technology stocks in a rising rate environment, let us build the portfolio that Druckenmiller's framework points toward if a crash starts tomorrow. And I want to be very explicit about why the phrase, if a crash starts tomorrow, matters so much. Because the portfolio you want if a crash has already happened is very different from the portfolio you want if a crash is starting right now. If a crash has already happened, you want to be buying aggressively into weakness, acquiring assets at discounted prices, taking on risk at exactly the moment when most people are running from it. But if a crash is starting tomorrow, meaning right now, today, at this moment, you are in a fundamentally different situation. You are in the situation where protection matters more than opportunity, where not losing is more important than potentially gaining, where the sequence of the next few months could determine the financial trajectory of the next 10 years of your life. And that is the situation that Druckenmiller's current public positioning and his current public statements are pointing toward for people who are listening carefully. The first and largest component of the portfolio that Druckenmiller's philosophy points toward in a crash starting tomorrow scenario is cash and cash equivalents, but not just any cash and not sitting idle. Specifically, short-term United States Treasury bills, the 3 to 6 month variety, held directly or through a government money market fund. Now, when I say cash is the first component, I know that sounds boring and maybe even counterintuitive. You might be thinking, if a crash is starting, should I not be buying things that will go up? And the answer from Druckenmiller's framework is absolutely not yet, and not without knowing what is going to go up. In every major market crash in history, the first phase is almost universally characterized by a flight to cash. Everything goes down, stocks go down, bonds go down, real estate goes down, gold sometimes goes down initially before it recovers, commodities go down. In the acute phase of a genuine financial crisis, the only thing that holds its value is cash, because cash is what everyone suddenly needs and no one has enough of. Having a substantial cash position when a crash begins is not a failure of imagination or ambition. It is the strategic foundation that allows you to do everything else intelligently. It is what allows you to buy assets at genuine panic prices 6 months into the crash when the opportunities are real and the risk of further decline is reduced. Without that cash foundation, you are a forced seller at the worst possible moment. With it, you are a patient buyer at the best possible moment. For someone in your age group, in the crash starting tomorrow scenario, I believe Druckenmiller's framework points toward a cash and short-term treasury position of somewhere between 25 and 40% of your total investable assets, depending on your specific age, your income needs from the portfolio, and your existing Social Security and pension income. The lower end of that range, 25%, makes sense if you have substantial guaranteed income from Social Security and pensions that covers most of your living expenses, because you are less dependent on your portfolio for day-to-day cash needs. The higher end, 40%, makes sense if your portfolio is your primary income source and you cannot afford to have it locked in illiquid or volatile assets during a market disruption. And again, this cash should be earning something. Treasury bills at 4 to 5%, government money market funds at similar rates, or high-yield federally insured savings accounts. Idle cash earning nothing is a Druckenmiller mistake. Productive cash earning safe, government-backed returns while you wait for opportunity is a Druckenmiller move. The second component of the crash, starting tomorrow portfolio, and this one might surprise you given Druckenmiller's concerns about government debt, is Treasury inflation, protected securities, known as TIPs. Now let me explain the apparent paradox here, because it is important to understand. Druckenmiller is skeptical of long-term nominal Treasury bonds, the regular kind, because he believes inflation is going to be structurally higher and that the federal government's debt trajectory means the bond market will eventually demand higher real yields, which pushes the prices of existing bonds down. But types are fundamentally different from regular treasury bonds because their principal value adjusts automatically with inflation. If inflation runs at 5%, the principal of your TIPS investment grows by 5%, and your interest payment, which is calculated as a percentage of that inflation-adjusted principal, also grows. This means TIS explicitly protect you against the inflation risk that Druckenmiller is most concerned about, while still giving you the credit safety of a direct United States government obligation. In the crash starting tomorrow scenario, short to medium-term TIPS, meaning those with maturities of 2 to 7 years, rather than the very long-dated ones, represent a genuinely attractive combination of inflation protection, credit safety, and reasonable liquidity. For someone in your age group, an allocation of 15 to 20% of your portfolio in TIPS held through a low-cost TIPS fund or purchased directly through Treasury Direct Gov fits perfectly within Druckenmiller's macro framework for this environment. The third component is gold. And here I want to spend some real time because gold is the asset that gets the most emotional reaction from investors of every age and the most misunderstood role in a portfolio. Druckenmiller has been public about his belief that gold deserves a meaningful place in a portfolio given the macro environment he sees. He has owned gold for years and has spoken about it in favorable terms in multiple interviews. And the reason is straightforward when you understand his macro framework. Gold is the asset that historically performs best in precisely the combination of conditions that Druckenmiller sees ahead: government debt that cannot be repaid in real terms, currency debasement as a result of that debt, and loss of confidence in paper financial assets more broadly. Gold has no issuer that can default. It cannot be printed by a government. It has been recognized as a store of value across every culture and every century of recorded human history, and in every historical episode of genuine monetary stress, genuine currency crisis, genuine loss of confidence in government-backed financial assets. Gold has preserved purchasing power in a way that paper assets have not. Now, I want to be absolutely clear that gold should not be the core of anyone's retirement portfolio. It pays no dividends, generates no earnings, and can be extremely volatile in the short term. But as a 10 to 15% allocation within a well-structured retirement portfolio, gold serves as genuine insurance against the tail risk scenario that Druckenmiller is most worried about. And the interesting thing about insurance is that its value is highest precisely when you feel you least need it. If you wait until the crisis is obvious to buy gold, you will buy it at panic prices. If you hold it before the crisis, you hold it at reasonable prices, and it does its job when the moment arrives. For practical purposes, gold exposure for someone in your age group can come in several forms. Physical gold, meaning gold coins or bars, held in a secure location, provides the most direct form of the asset and is genuinely outside the financial system in a way that has real value in extreme scenarios. But it also requires secure storage and insurance and is less liquid than financial instruments. Gold ETFs, particularly those that hold physical gold and are backed by allocated gold and secure vaults like the SPDR Gold Trust or the iShares Gold Trust, provide easy, liquid, low-cost exposure that is accessible through any brokerage account. And for people who want gold exposure within an IRA or other retirement account, a gold ETF is often the most practical approach. The specific vehicle matters less than the principle of having meaningful gold exposure somewhere in the 10 to 15% range as part of a portfolio structured for the environment Druckenmiller is describing. The fourth component of the portfolio, and this is where we start getting into the equity portion for those who believe, as Druckenmiller does that some equity exposure is always appropriate, even in a dangerous macro environment. Is dividend-paying value stocks, specifically in sectors that have historically performed well in inflationary environments. Druckenmiller is not someone who says get completely out of stocks. What he says is that the composition of your equity exposure matters enormously in a high inflation, high debt environment. The growth stocks that dominated the last decade, the companies valued at 50 or 100 times earnings based on expectations of future growth, are the most vulnerable in the environment he sees ahead. But the value stocks, the companies trading at reasonable multiples of current earnings, with strong cash flows, durable competitive positions, and the ability to raise prices when inflation pushes their costs up, these are a fundamentally different proposition. Think about the kinds of businesses that performed reasonably well during the inflationary 1970s. Energy companies, because the price of their product went up with inflation. Consumer staples companies, the makers of food and household goods that people need regardless of economic conditions and who can pass higher costs on to consumers. Healthcare companies, because healthcare costs inflate faster than general inflation and demand is largely inelastic. Industrial companies with pricing power and hard assets. These are the kinds of equity exposures that fit within a Druckenmiller aligned framework for an inflationary crash environment. For someone in your age group, I would think about an equity allocation of perhaps 20 to 25% of total assets, structured heavily toward value over growth, toward dividend payers over pure capital appreciation plays, and toward the inflation-resistant sectors I just described rather than toward the high valuation technology names that dominate the major index funds. This is an important point because many people in your age group who think they hold a diversified portfolio through an S&P 500 index fund are actually extremely concentrated in a handful of mega cap technology stocks. At various points in recent years, the top 10 stocks in the S&P 500 have represented 30 to 35% of the entire index. That means a supposedly diversified index fund is actually a highly concentrated bet on a small number of technology and technology-adjacent companies. In the environment Druckenmiller is describing, that concentration is a vulnerability, not a feature. A deliberate tilt away from those mega cap technology names and toward value, dividends, and inflation-resistant sectors is entirely consistent with his framework and entirely achievable through a combination of low cost value-oriented ETFs and individual dividend-paying stocks if you have the interest and confidence to select them. The fifth component of the portfolio is international and commodity exposure, and this follows directly from Druckenmiller's concerns about the dollar. If the dollar weakens over the next decade as a result of the fiscal and monetary dynamics he is describing, then assets denominated in other currencies, particularly in currencies of countries with stronger fiscal positions, become relatively more valuable in dollar terms. A European company that earns its revenues in euros becomes worth more dollars if the euro strengthens against the dollar. A Japanese company that earns yen becomes worth more dollars if the yen strengthens. And commodities, which are priced globally and whose dollar price tends to rise when the dollar weakens, provide another form of dollar hedge. Druckenmiller has spoken positively about certain commodities, particularly energy-related commodities, given his belief that the world is in a structural period of energy supply constraints. The transition to renewable energy is happening, but it is happening more slowly and with more difficulty than many proponents projected. And in the meantime, the world still runs primarily on oil and natural gas. the supply of which has been chronically underinvested in the last decade as capital has fled the sector due to environmental concerns and uncertain future demand projections. That underinvestment in supply, meeting continued and in some cases growing demand, creates a structural backdrop for energy prices that Druckenmiller finds compelling. For practical purposes, a 5 to 10% allocation to a combination of international developed market value stocks and broad commodity exposure, particularly energy, fits within the Druckenmiller aligned portfolio. This can be achieved simply and cost-effectively through a low-cost international value ETF and a diversified commodity or energy ETF available through any major brokerage. Now let me put this all together explicitly so you can see the complete picture. In a crash starting tomorrow scenario aligned with Druckenmiller's macro framework and calibrated for someone in the 60 to 75 age range, the portfolio looks roughly like this: 25 to 40% in cash and short-term treasury bills, earning 4 to 5% while providing maximum liquidity and dry powder for future opportunity. 15 to 20% in short to medium-term treasury inflation, protected securities, providing inflation protection with government credit safety. 10 to 15% in gold, providing insurance against monetary stress and currency debasement. 20 to 25% in dividend, paying value stocks tilted toward energy, consumer staples, healthcare, and industrials, providing some inflation-resistant equity participation without the extreme valuation risk of growth stocks. And 5 to 10% in international developed market value stocks and commodities, providing dollar diversification and exposure to the commodity cycle that Druckenmiller sees as structurally favorable. Add those up and you get a portfolio that is genuinely defensive without being paralyzed, genuinely inflation aware without being speculative, and genuinely positioned for the risks that Druckenmiller sees as most pressing without abandoning the growth potential you need to fund a retirement that could last 25 or 30 years. I want to be honest with you about what this portfolio will and will not do. In a